So a lovely little aggregator hit #1 on StockTwits today, held its place for #1 on Reddit, and if you look at the most actively traded stocks today by volume, a little aggregator made it to the top 3. I only have one word for you. Attaboy. And we broke ground deep into the 6s today, a day before a huge amount of in-the-money call options are set to expire around the 5 and 6 strike prices. Coincidence? Who would have thought this could happen? I don't know, folks. I want to violently give you my take on what happened today and how that projects what's going to happen moving forward. Is this going to skyrocket further, or is the play over? Is it time to sit under a tree and get some adder shade while drinking some Aterade? Are we about to see an adder fade? We will discuss exactly that. But as always, we will be starting with an update on the overall market and place. Okay, so Marketa, apparently people like stocks again today. You got the sleepy Dow up 1%, the S&P up 1.12%, and the Nasdaq up 2%. I feel like the tech sector is run by bipolar parents. One day they wish the tech sector was never born, and the next day it's the golden child. It's really a beautiful process and almost a waste of time to even commentate on. Of course, right now, you know what we're in. We're in a short-term trader's market. Lots of opportunity in the volatility and lots of opportunity in catalysts. One that you'll notice appeared on our briefing again this morning was Veru, and the Veruvians were very happy again. Veru broke back into an upward direction today after a breather yesterday. So why did I brief on it again? We were just talking back on Monday about the need to lock in profits after its successful run from like $5 to $14. And then yesterday we were talking about how it got disqualified with a break back below our downward directional SMA. So why did it appear on the briefing again? Well, I included it because I saw proof of concept in the pre-market with new momentum, which had caused it at that time to once again break back over our red directional SMA line and retake an upward direction. I was also seeing the media praise its COVID drug success, which any sort of attention can drive a lot of hype and capital into small cap stocks. But really what was special about Veru and the Veruvians was on the options chain. If you head over to the options table, it had a very similar dynamic to Ater, which we'll discuss later, but it had a very similar dynamic to Ater, if not more extreme, where if this had rallied back to previous levels, well, all of a sudden you'd have all of these contracts set to expire in the money tomorrow at 12.5 and 15, and potentially trying for a moonshot to 17.5, which is the biggest held call option right now. So you have this dynamic where if it did rally and retake its previous runs, all of a sudden you'd have this dynamic where market makers would subsidize your run higher, having to hedge in order to stay neutral before they have to close out those options. But what I didn't see coming was this analyst upgrade from Oppenheimer towards the end of the day, which said Veru could hit $36, which was kind of the perfect timing, especially if it causes, again, these $17 strike prices to get hit. So yeah, pretty fun day for the Veruvians. The other case study from this morning's briefing was KLDO. So we briefed on it 30 minutes prior to market open, and it had a quick near double at market open before fudding out and breaking into a downward direction. How did we find this and why did I like it? Well, once again, I saw proof of concept in the pre-market, aka it had already shown ability to get interest. Number 2, the setup was already fit for an overreaction play. The company announced something that's pretty much the worst thing a company can announce. They said they're ceasing operations. And the stock dumped massively on that news from 192 to 14 cents, which, I mean, it makes sense that it would drop that much on this news. I'm not saying it doesn't. But when you have that kind of drop, you often get arbitrage opportunities of people trying to play small rebounds that could end up being doubles or triples. One of the most famous examples is that 2020 Hertz trade. Again, one of those opportunities where if you didn't have clear entry and exit plans, you would have just lost all the gain. Clear entry and exit, confirmation, validation, stop loss, whatever it is. I don't understand why people want to get stuck holding a company that literally just ceased operations. But anyways, this is the full catalyst section from this morning's briefings. We had 6 catalysts and 1 warning on SST. That leads me to the ticker of the hour. Ater's run this past couple of weeks has been beautiful. It's like an elegant piece of art. I wish that I could hang it on a wall and just admire it all day and night, don't you? Art, what does that remind me of? Have you considered art as a way to diversify your portfolio? A lot of folks stick with what they know. Stocks, real estate, and maybe even crypto. But if you do what everybody else does, that means you're going to get what everybody else gets. That's why I am a huge believer in putting in the effort to learn about ways of diversifying that average people don't even think about. And a big example of one way is with art. It has historically been one of the preferred assets and investments of the elite. And likewise, it also has a historical average appreciation that outpaces most asset classes. And now thanks to Masterworks, it's open to all of us. No need to have millions of dollars and show up at an auction. You can scan through tons of different hand-picked art pieces in their database and pick out ones that resonate with you the most. Whether that's from famous artists like Basquiat, Picasso, Warhol, Matisse, or many more. Masterworks allows you to buy and hold fractional shares of them, instead of having to own the painting outright. And so far, they've returned over 30% net IRR to investors after selling 3 paintings. Learn more about investing and diversifying into art by going to masterworks.art/ZipTrader or by clicking the link in the description below. Thank you, Masterworks, for sponsoring this video. Now back to the content. Okay, so Aterian. Now, one of the big reasons I cited yesterday for bullish on the Ater setup towards the end of this shortened week was because you have all of these call options that are going to be expiring on Thursday, which is now tomorrow. And if the aggregator held above $5, that means that not just the $4 strike price or the $4.50 strike prices and everything below that would expire in the money, but the big daddy, the big papa of Ater options, the $5 strike price calls, would expire in the money. 20,196 contracts, which is more than the $4 and $4.50 strike price options combined. So if Ater held above that, you have this cascading effect of all of these options suddenly being in the money, which from a market maker standpoint had a very, very low probability of happening when these options were written and as most of this week progressed. So what happens when you have a big move like this, where you're in a dynamic where low probability call options all of a sudden have a very, very high probability of being in the money? Well, market makers need to quickly maintain neutrality. So to hedge, what do? Number one is they buy a certain number of shares or a combination of other maneuvers like buying further into the money call options. You also have this dynamic where if market makers had rapidly sold call options without having adequately hedged and the stock price had rose rapidly, well, before those options get exercised or before they expire, the market makers are going to have to rush to buy some shares to fulfill those, which is almost always fine. Maybe it creates a little buying pressure, but the problem with Ater is that shares are super, super tight. If you want shares, you got to bid up the price a lot. Utilization is 100%. Cost of borrow fees make gas prices look like a walk through the park, and the stock has already been lent out to oblivion, increasing the chance that market makers rushing to buy shares would have had an outsized impact on the share price. And we saw this dynamic to some extent play out last week as well. And the game has shifted heavily upward, and you've seen some big retention of value, which most shorts did not think would happen, and the market makers didn't think would happen, at least the algorithms. All of these call options, even as low as $4 and $4.50, were not expected to be hit and expire in the money on Thursday. So what ended up happening today? Lots of stuff happened. The rally today drove the $5 strike call options deeper into the money, and that drove a decent amount of exercising. We've now dropped from 20,196 contracts to 16,985 contracts for that $5 strike price. Now, remember, if you're in the money on your bought call, you can decide to go to the gym and exercise it, and what does the market maker have to do? Well, the market maker has to find shares to fulfill your contract. You could also simply just resell the contract to somebody else before the expiration. But today we did see some exercising, and the exercising of options at these higher prices puts pressure on market makers to what? Chase the stock up in order to continue hedging and stay neutral, while also delivering some of the shares that they probably already understacked to people who had these call options at higher strike prices. On top of that, this morning, what you saw was the probability of Ater holding above $5 into expiration increased dramatically, which meant that the short sellers were forced to further hedge on top of, again, delivering shares to exercisers. So you had both an increased need to hedge at the same time where people were redeeming some of your previous hedges. And in totality, I would argue that today's rally to 664 was a result of a combination of a gamma squeeze and a FOMO rally, as well as some momentum traders piling in on top. If you look at this overall, when we originally called it out on Monday the 4th, when it was at $2.50 a share, probabilities of this continuing momentum into a broader risk-off environment were close to nothing. Market makers had to adjust again and again as this rallied, and the liquidity situation on the short side has made it so much more difficult for them to do so, which has fueled a lot of these little mini gamma squeezes that keep happening week over week. But if you want to know what is going to happen tomorrow, look at what happened towards close today. After that 664 run, it started dropping. Reasons for this? Well, think about what happens when you exercise a call option. The call option gets a six-pack and goes out and flirts with put options and hopes that he doesn't strike out. But when you exercise a call option, at its core, what happens? Well, you receive underlying shares at your strike price. But if you are exercising a day before you have to, prior to expiration, odds are strong that you're simply not interested in continuing to have a bullish position in this, and you want to lock in your profits. So what happens? Well, market makers have to rush to give you the shares and further hedge themselves. We went through this, but then shortly after, you decide what? Well, again, you don't want to have that bullish position anymore, so you're going to go and you're going to dump those shares onto the market. That, I believe, is what catalyzed the downtrending and sell-off towards market close today. Now, if you do the math on how many options were exercised today throughout the options chain, it wasn't enough to drive the entire drop, but it was enough to catalyze it, especially considering the liquidity issue here. Once you've started dumping tons of shares onto the market, all of that massive accelerating buying pressure that has to keep bidding and bidding up a shortage of shares, all of a sudden finds shares to buy, and then the price starts going down, and then you spook some of the momentum traders. Now, if you're playing three-dimensional chess here and you extrapolate what happened today and think about what's going to happen tomorrow, if I had to spitball it, I would say that net and in effect, it's going to be a breathing day for the stock and probably a substantial breathing day. But there's still incentive for markets based on where this retains its value. If you go out another week, the most concentrated call option isn't the $5 strike price, it's the $3.50 strike price, which means as we enter next week, if we are in the fives, you're now putting pressure on the market makers to once again have to hedge for a higher probability of the $4 strike price, the $4.50 strike price, and the $5 strike price being hit, and perhaps even the $6. So if you're asking whether I'm still bullish on the setup into the next week, the answer depends on whether or not this can manage to retain $5 or $6. But the short-term momentum in gamma squeeze talk kind of misses the bigger picture with Ater. What the bigger picture is that with Ater, you have a stock that is getting crushed by the shorts. So sure, over the next week or two, your prices will be driven by many of the same considerations that drove them the last 2 weeks. But the big potential carrot at the end here is that short squeeze. Most stocks that people expect to short squeeze never end up squeezing, they just rally because people are buying them. Slightly more of them have mini gamma squeezes as market makers never anticipated the runs that they do have. Right now you're in this rare situation, in this market environment at least, where you've had several uptrends that then breathed and then uptrended again and then breathed. That's pretty rare, and if you look at most trades, they never make it to this point, and fewer make it to the next point, which is staying relevant enough to have a massive squeezy McSqueeze on the short squeeze level. So in the short term, I mean, there is incentive for this to go higher if it holds different retaining levels. But if you're looking at it from a 2 to 3 to 4 week standpoint, this momentum adds up very, very quickly. But at the end of the day, folks, always remember that Aggregator's gonna add a gate. I said this on Sunday and probably last week as well, but if you're up 50, 60, 70, or even 100% on this, don't feel bad and apologize about taking profits. If you're somebody that just likes to trade the short-term momentum day to day, don't feel bad about doing that either. At the end of the day, you and only you will be rewarded or punished based on your trading decisions. Every new hype stock will go down eventually, so you always have to make sure that you're protecting yourself and keeping expectations reasonable. Trading hype stocks is kind of like musical chairs. You don't want to be the one stuck without a chair. Anyways, folks, have a good rest of your day. That concludes today's video. Thank you, Masterworks, for sponsoring us. If you want to learn more about investing in art, I'll put a link to that below. If you're looking to learn how to trade with our step-by-step lessons, private chat, daily morning briefings, as well as full price target list, I'll put a link to ZipTrader U in the description. Coupon code NEVERGIVEUP, which expires on April 30th, is below as well. Make sure to use that before checkout. Prices on the course will go up afterwards. Anyways, have a good one, folks, and I'll see you tomorrow.